Hello and welcome to Finance RM. In this lesson, we will talk about initial public offerings or IPOs. So, what are IPOs? An initial public offering is when a private company transitions to a public company by selling its shares on a recognized stock exchange such as NYSE, NASDAQ, LSE, NSE, or HKEX. What it means for a company. The private stage is ownership concentrated in founders, family offices, venture capital VCs, private equity PE, and employees via stock options. The public stage is ownership distributed across millions of shareholders, including retail investors, mutual funds, hedge funds, pension funds, sovereign wealth funds. The objectives of going public include capital raising, which, unlike bank loans or debt, IPO raises equity capital which has no repayment obligation, unlike bonds, no interest burden, which is improving debt to equity ratios, a stronger balance sheet, higher credit rating, easier to borrow later at cheaper rates, and the liquidity creation from founders, angel investors. VCs eventually want exit opportunities, and IPOs give them a public market to sell shares. A valuation discovery is that the stock market establishes a market-driven price, which is useful for collateral and loans, benchmark for mergers and acquisitions, and basis for employee stock compensation. Strategic benefits includes enhances brand visibility and trust, improves talent acquisition, and the shares can be used as an acquisition currency in stock-based deals. When do companies usually do their IPO? Typically between 5 to 10 years of operations, and when they have steady revenue growth, predictable cash flow, industry conditions are favorable. Examples include Amazon, which in 1997 IPO was $18 a share and raised $54 million, which was used to expand its infrastructure. Facebook, which in 2012 IPO at $38 per share, raised $16 billion as one of the largest IPOs, and it gave liquidity to early investors. And WeWork, which failed 2019 IPO, pulled due to weak fundamentals and governance issues, showing that not every company is ready for an IPO. The types of IPO and pricing mechanisms. IPO structures include fresh issue of shares, new shares created, dilutes existing ownership but raises growth capital. An example includes Uber IPO in 2019 as large fresh issue to fund operations, an offer for sale or OFF, which is existing investors sell their shares. The company receives no new funds. An example include Alibaba's secondary offering in 2019 was mainly an OFS. And hybrid IPOs is a combination of fresh issue plus OFS, which is an example the Zomato IPO in 2021, which both raised funds for company and allowed VC exits. Pricing methods include fixed price IPOs, which is predetermined price set by company and underwriters, simpler but less responsive to demand, rare for large IPOs. Book building, which is the most common, which is price band announced, let's say $40 to $45. An investor placed bids within band, and a final cutoff price decided where demand and supply. Allocation priority often given to institutions. A Dutch auction, which investors state both quantity of shares and prices willing to pay, shares allocated starting from highest bid downward until fully subscribed, and a final price is the lowest accepted bid. It's used by Google IPO in 2004 to democratize access. And the role of underwriters is usually top investment banks such as Goldman Sachs, Morgan Stanley, or JP Morgan, and their functions include advice on timing, pricing, and structures, market shares via roadshows, guarantee sale of shares, firm commitment underwriting, and stabilize stock in early trading via green shoe option, temporary extra shares to balance demand. Underwriting fees is typically 5 to 7% of funds raised. In a $1 billion IPO, banks may earn $50 to $70 million. IPO process and key players. The IPO process can take 6 to 18 months and involves multiple steps. The key steps include the preparation, which is the company selects underwriters, auditors, and lawyers, and an audit of last 3 to 5 years of financial statements. The prospectus is drafted, and the regulatory review, which is the review disclosure documents, requires full disclosure of company's financials, risk factors, management background, and litigation history. The roadshow and marketing is 1 to 3 weeks of global presentation to large institutional investors, and it collects indications of interest. Book building and pricing is demand data analyzed. It's the final price fixed, often near upper band in hot markets. And allocation is shares distributed across categories and 50 to plus institutions as 15 to 20% of high net worth individuals and 30% retail investors. On the listing day, the shares officially trade on the exchange and the price discovery happens instantly. The key players include the company and management, which provide disclosures and strategic direction, underwriters, which are structure, market, distribute IPO, and regulators, which approve filings and protect investors. Institutional investors, such as mutual funds, insurance companies, and sovereign wealth funds. Retail investors include general public applying for shares. The advantages and disadvantages of IPOs. The benefits for the companies will include the capital influx, huge funding without debt, liquidity for investors as early backers cash out, brand value, listed companies get global visibility and acquisition power as use stock as acquisition currency, as well as employee benefits, attractive stock option plans or ESOPs. Drawback for companies include costly as legal, underwriting, and compliance will cost millions, loss of privacy as full disclosure required of financials and risks, the regulatory burden of quarterly reporting, annual audits, and dilution as founders lose ownership percentage, as well as market pressure focus shifts to short-term earnings over long-term vision. The pros for investors include the high returns as early growth stage entry, diversification as new industries in portfolio, liquidity for traded daily on the stock exchange, but the cons for investors include the volatility as listing daily can swing from 30 to 100%, overvaluation as hype can cause inflated pricing, and lockup expiry as post 180 days insider selling often causes price drops, and failure risk. Many IPOs underperform index over long term. According to studies, 60 to 70% of IPOs underperform the market after 3 years. Risk, return, and liquidity consideration. Major risks for investors include overpricing risk, as companies may overhype growth. Example, Snap Inc. IPO in 2017, initially priced at $17, surged to $24 and then fell below IPO price within months. Asymmetric information. Insiders know company health better than retail investors. And market sentiment risk. Even solid companies flop in bearish markets. Lockup expiry risk. Example, Uber's lockup expiry in 2019 led to massive share sell-off. Governance risk, which weak corporate governance can kill IPOs. Example, WeWork's cancelled IPO in 2019. And returns include short-term listing gains, as many IPO investors aim to flip shares on day one. Example, Snowflake IPO in 2020 priced at $120, opened at $245, which is 104% extra. Long-term wealth creation, as Amazon IPO in 1997 at $18 is now thousands per share. Apple's IPO in 1980 at $22 is now one of the world's largest companies. Liquidity advantages include the shares trading daily, easy to enter and exit. The challenges include early days, often highly volatile with thin order books, and due diligence checklist or investor toolkit, which before investing in an IPO, always analyze the company financial, the revenue growth, EBIT data, margins, debt ratios, the valuation multiples, PE, PBV, EF, EBITDA versus the competitors, industry outlook, expanding or shrinking market, use of proceeds for growth or just debt repayment, corporate governance, board independence, audit track record, and lockup expiry dates, insider selling risk. The final takeaway that you should take is that IPOs are opportunities and risks bundled together. They can create life-changing wealth such as Amazon, Apple, and Google, but also destroy capital such as WeWork attempt, Groupon, or Pets.com. Smart IPO investing requires deep fundamental analysis, valuation awareness, and monitoring of market conditions. Thank you, and remember to please subscribe to the channel and drop a like on the video. Comment any questions you have or advice for the channel. Remember, be smart, stay smart, and achieve your financial goals.